Hello, everyone, and welcome to our March investment market update. Today, I'm delighted to be joined again by Charlotte Lambeth, who is the Director of Private Clients in Exeter. Hi, Charlotte, how are you?
Hi, I'm good, thank you.
Good. Thanks for joining us again. Really appreciate it.
No problem.
So I think you've got some slides for us to talk us through some stuff of what's been going on over the last few months, and hopefully some positivity.
What might be down the track? Absolutely. Right, let me just get my slides on the screen, hopefully. Hopefully that's come through all right.
That's come up okay. Brilliant.
Super, fabulous. Well, thanks very much for having me back. It's nice to see you. It's a little while since we caught up, and there seems to have been quite a lot that's happened since we last spoke. So I was just going to very briefly revisit some of what we said last time and see how that panned out before we maybe look at what might be coming down the track over the next few months. So this is the psychological cycle which overlays the stock market cycle, indicating how it feels to be an investor when markets are falling and indeed rising. And in November 22, talking to you, I showed this slide, wondering if we might be at the capitulation stage. And at that stage, I put forward a case for 2023 being a positive year overall for markets. Now, it was quite a roller coaster year, but overall, 2023 did make investors money in most major markets, albeit much of that return was focused into the last couple of months of the year. And I just thought I'd remind us how it ended up. So this was sort of 2023, you can see highlighted in the red box there. Effectively, it was a tricky year, getting trickier into October, when particularly we had the extra geopolitical issues when the situation in the Middle East sort of kicked off. And then suddenly November came and we started to see a real lessening in inflation pressures. And that had been really weighing on markets throughout 2022, 2023 up to that point. And suddenly people thought, oh, we're through the inflation blip, that'll allow interest rates to come down. And we saw markets really take off in November and December as a result of that. It's fair to say that, particularly looking at that slide, you'll see that Japan did very well. Also up there is the US S&P 500. Now, again, I think one of the things we talked about in a previous chat was the concentration of returns in particularly those tech stocks with exposure to AI and that artificial intelligence story. And that really was a key driver of the US market. The so-called Magnificent Seven stocks really did drive about 70% of the performance that we saw in the S&P 500 last year. It also was quite a key driver for some other markets with exposure. So some of the chip makers in Asia and so on did benefit from that story as well. But the net result was there definitely was money to be made in 2023 if you stuck with it, which I know is one of my perennial cries. So that was kind of how last year looked. What might this year look like? In general terms, I think it continues to be broadly about inflation and interest rates. When we spoke in May last year, I said the situation was quite opaque, but that a soft landing in the US was possible. I think we feel that maybe that soft landing looks more probable now. The concerns that we were talking about at that point in the US regional banking sector have waned. I wouldn't say they've gone away completely, but it's certainly the focus has moved on from that somewhat. I think it's fair to say that we're now at a point where perhaps the easy work has been done on inflation. I think a bit like losing weight, getting the last couple of kilos off can be the toughest. And I think, you know, we've got well down into single digits from double digits, but getting down to that 2% target is probably going to be a bit tricky. So that's an area that we're keeping an eye on, but in general terms, employment numbers and so on are still holding up fairly well. The economy over there still looks quite strong. I think one question that we're getting asked quite a lot is sort of around life beyond the Magnificent Seven that we talked about earlier. And just as a reminder, we're looking at the likes of Apple, Microsoft, Amazon, Meta, which owns Facebook, Tesla, Nvidia, the chip maker that drives a lot of this AI stuff. And as I say, I previously looked at the concentration of returns in those stocks. It really was tremendous last year. They were up 75%. The rest of the S&P was up 8.2%. That's what gives you the overall return on the index of 24, basically. So it's very, very focused. One of the things I think that's probably reassuring in some ways is that so far in 2024, we have seen a bit of a widening in that positive performance of the American market. They remain a key element, and certainly those returns are instrumental in driving it to the new highs that we've seen recently. But we have seen some other stocks coming in, the likes of Eli Lilly and so on have also been doing very well this year. We need to be a bit careful. Concentration levels are now actually higher than they were during the tech bubble in the early 2000s. So, it really is notable even by historic standards that we've got this concentration in those stocks. Where perhaps it's different is the fact that these are companies that are delivering earnings in a major way. So back in the tech bubble, part of the problem was that we were investing in companies that, anything that had .com at the end of it, was a surefire winner. And a lot of it was in the hope of earnings coming through in the future, but a lot of these companies had never made a profit, despite the multiples that they were on. I think the difference now is the fact that these mega caps are delivering nearly double the margin of companies in the rest of the market. But they don't look cheap at the moment. They're on 30 times forward earnings versus 18 times for the rest of the market. So, they're certainly priced for success. And I think, if they were to disappoint, that could be problematic for the valuations that we're looking at the moment. And
I
meeting
think, Charlotte,
those,
therefore, is that not a very strong rationale, that whole point there about ensuring that you do have good diversification in a portfolio? Because whilst, if you weren't in Magnificent Seven a couple of years ago, you could have seen some astronomical rises, but equally there could be disastrous drops. And I do appreciate the subtle differences between, well, not subtle, but the big differences between the 1990s and today. But even so, I think it still stands true that having that level of diversification, because it doesn't take much for a situation to turn and for those overinflated valuations to be impacted. It could be, I guess, legislative change in a market that they were expecting to go very, very well. And I'll use China as that classic example, because if there's a political change later in the year in America, then it has a knock-on effect in maybe China, then I guess you could see that some of these larger companies could have a real impact on their valuations.
Absolutely. It's worth bearing in mind that, as I say, 2023 was hugely driven by these companies. Kind of so was 22, but in the other direction, where actually they were getting punished for being growth stocks. They weren't providing dividends in the interest rate environment we were in at that point. They were pretty terrible, really. So certainly these stocks can be very volatile, and if it goes against you, that can be problematic. It is worth pointing out that actually Tesla, although a really important part of positive returns last year, is actually a negative contributor to what's been going on this year. Variety of factors, from things like some of the really big rental companies over there, like Hertz, moving away from electric vehicles to some extent because they're finding that it's not suiting their fleet. It's causing them problems. So they're actually selling a lot of Teslas back onto the market. That's obviously meaning there's a lot of secondhand supply, and people are worried that that will impact on people buying new cars. There's also been, and I think this is possibly an interesting trend given the personalities involved in some of these companies. A lot of them are very, very tied into kind of key founders. And actually, we have seen some active movement away from support for Tesla because of the actions of Elon Musk. And there are companies that have withdrawn tax benefits for employees buying electric cars if they buy a Tesla, so they can still get the benefits if they buy another electric car. But actually, companies are saying they're not prepared to support Tesla because of some of the things that Mr. Musk has been saying, and the fact that people see reputational risk in being connected to that. So there are some interesting trends and possible future risks that could be seen there, and it's, you know, an example of one where one of these stocks has been coming backwards as a result of that. So you're absolutely right. You know, we've definitely seen a bit of underperformance relative to some of our benchmarks because we don't have the weightings in these stocks that you would have to keep up with them. I mean, you know, Apple's market cap is larger than the entire UK stock market. You know, if it was a country, it'd be in the G7. It's a massive, massive corporation.
Absolutely crazy, isn't it? Absolutely crazy.
If you were to have a weighting to that, it would be at the, as I say, at the geographic country level almost. But the risk you're taking there is astronomical. So,
and I think what that shows is that, again, for me, just highlights the reasons and the strong rationale for an active sort of overlay in terms of how people put their money, or where people put their money. Because if you're just tracking the market, then effectively you are getting a percentage of whatever the you know, Apple make up of the S&P 500. It could be 7, it could be 9%. So a lot of exposure, a lot of eggs in one basket. Yes. And it's very easy, I think, to sit there and go, look how well they've done. Yes, they have, but that is very high risk. And then we've got to put that into context of people's objectives, what they're trying to achieve longer term. Do you need that level of risk? Do you need that level of return as well? There are far safer ways to get returns that are steady and solid along the way.
Absolutely. Yeah. And I think, you know, governments are looking more closely at how these companies operate. I think you mentioned regulation. There's certainly antitrust legislation that could be coming down the line. Taxation is something that, you know, lots of countries are looking at to try and see how they can get a bigger piece of the pie as far as these companies' profits are concerned. So there's definitely risks out there, you know, that might see some of these valuations pull back a bit. And also, I mean, fundamentally, whether they can meet these earnings forecasts is going to depend on whether AI can really deliver. You know, if it is the game changer that people are thinking, then actually you'll see prices continue to rise and pick up, because actually what they're able to achieve will grow dramatically as a result. But if, you know, if actually it takes a bit longer, or we're not yet at a stage where we can rely on it, and clearly, you know, we're all seeing in the news lots of things around the potential issues that there still are with this. It's very much a new and early stage technology. So, you know, how long it takes us to get to a point where it's really giving that productivity boost is still a question mark. Yeah.
So in terms of all of that, that's great to hear what's been going on with the American market and other bits and pieces. But the thing you pointed out at the beginning was you still think a lot of 2024 is going to be around interest rate changes and inflation. And obviously, timely, we've just had the numbers out in the UK that inflation's down to, I think it was 3.4%.
Yeah.
So obviously that's a big improvement. I had my letter from my electricity provider telling me that my kilowatt per hour cost was going down by 4p. Just in time for the warm weather. Well, we hope warm weather, but obviously we understand supply and demand and everything else. But the fact that that's also coming down means that I guess we will then hopefully continue to see inflation dropping. And noted last night, Andrew Bailey's actually come out, the governor of the Bank of England, to say that rates are coming down and will come down, which is probably the clearest indication that they think it will happen sort of mid to late this year. So maybe August, September. Is that your general view on it?
Yeah, I think so. I mean, certainly, you know, fixed interest and bank deposit rates, that sort of thing, you know, we are clearly at or past actually probably the peak. You know, expectations are definitely for rates to begin coming down effectively at the moment, possibly starting from June, and then with maybe a further 3 cuts to come after that. You know, seems to be the market consensus at the moment, whether you're looking at the US, Europe. In the UK, yes, maybe fractionally later. You know, might be you know, might be June, might be a little bit later, but certainly heading in a downwards direction. And on that basis, I think therefore, you know, if you've got cash that should be cash, you know, it's part of your emergency reserve funds, it's that readily you know, accessible money for bits and pieces that crop up, but you think you could tie it up a bit, now is probably a great time to be looking for fixed rates, because I think those will definitely be heading in a further downwards trajectory from here. I think, you know, from our perspective, using you know, thinking about asset allocation and also the stocks that we're using within those asset allocations, it's also changed, or been one of the biggest changes that we've had for quite some time, because since the banking crisis, where interest rates went pretty much to zero, we've not been able to use fixed interest in the usual way that we would in portfolios. You know, it should be a dull and boring thing that provides some income and maybe a bit of capital return and a lot of stability compared to the equity component. That's what we all learn in the basics of portfolio construction. But with zero interest rates, that doesn't work anymore, and it hasn't been the case for the last 15, 16 years. Finally, with interest rates going up again, you know, all those things we thought we knew come back onto the radar. So we've been able to move assets that have perhaps been in alternative spaces. You know, we've been having to use things like infrastructure and so on to try and gain that reasonably high income, slightly dull and boring exposure instead. But we can actually use fixed income, and in particular gilts, which are great because they're quite tax efficient. You know, any capital gain on a gilt doesn't have CGT implications, with allowances having been cut so much. That's always useful. And of course, it's relatively cheap because you're often only needing to trade one way if you're intending to hold to maturity. So it's definitely allowed us the ability to use those types of assets again. And that helps with costs on portfolios, tax efficiency of portfolios, as well as you know, giving us some good opportunities.
Well, I think that becomes more important as we see the tax breaks for investing getting tighter and tighter. Capital gains tax, for example, coming down again in April to £3,000 per person. And you know, we touched on this in our last investment webinar, where we talked about the fact that, you know, the rule books were almost ripped up for the last 14 years, and then it's now we're back to exactly that, what we learned in economics, risk-free returns, all that sort of stuff. And it's nice to be able to probably go into this period of time, and I think that's the positive bit I take from this, is that whilst we've had a quite frankly difficult few years, there's been a reset on investment markets in some ways, alongside what else has gone on in the world economy. And from an purely investing perspective, it hopefully gives everyone some comfort to think we're back on what is more firm territory, you know, a well-trodden path of old days, and therefore hopefully that familiarity and understanding of what we expect to happen now should give us some reasonable upside, assuming inflation comes under control and interest rates come down and everyone else in the world behaves themselves.
Absolutely. And yeah, I mean, clearly there are some risks out there, you know, geopolitical, we've already mentioned to a degree. There are some elections happening this year. In fact, actually, there's a ridiculous number of elections happening this year. Something like 50% of the democratic world is having elections this year. We had a shock result earlier this week with Putin coming coming back into power in Russia, and no one saw that one coming. So you know, that perhaps not the biggest shake-up. We've got elections in the UK at some point this year, probably a similar time to US elections. I think from a market perspective, we're not anticipating that the UK election will really make much difference, to be honest. No. You know, historically, they don't have a huge impact. And I think we are in a situation where you've got two pretty centrist, you know, parties heading into it. The fact that we saw several Labour policies turn up in the recent budget tells you that they're not a million miles apart in what they'd be looking to do. So, you know, from that perspective, I don't think anyone's thinking it'll be too crazy in either direction. I think they feel they can price in approximately what will be coming down the line on that. And, you know, in some ways, I think it'll be potentially more work for you, dependent on what the result is, you know, on the personal taxation front and how that all fits together with pensions and that sort of thing. So market-wise, I think in the UK, it's not going to make too much difference. I think the US election could be the one where there's potentially more clear blue water between the candidates and what you might expect from them. At this stage, yes, one would be looking at a Trump v. Biden situation. Having said that, I do still find myself wondering whether when it actually comes to election day, it'll be Trump v. Biden that you're voting for, because it also feels like there could be issues that crop up for both of them that actually prevent them from being the name on the ticket between now and then. So I still think there's some question marks there, albeit, you know, I think that's what they're heading for. Probably the key area where you'd have a difference is foreign policy. I think the outlook for what happens in Ukraine under a Trump administration would obviously be different to under a Biden administration, and there are possibly some knock-on impacts of that, which could make a bigger difference. Our view at the moment is there's a lot to be got through before we get there, even though we've got the election in November. Obviously, no one's taking office till next year. And I think it also is going to depend quite a lot on what happens with the other houses supporting a president. It's been a very long time since we had a president with a big majority backing them in the other houses. So that has definitely, I mean, in some ways it's been problematic because it's hampered people's ability to get through what they might otherwise have wanted to. In some ways, you could say on the plus side, it's hampered people's ability to get through what they wanted to. So
it's kept a balanced approach in some ways as well, hasn't it? So it's exactly. I think you're right. There's almost a bit of a stalemate. Which so on that, if we were, would you mind going back to your screen a moment ago where you had your index of where we might be on the emotional scale?
Well, it's funny you should say that. I was actually, I've got an updated version. So yes.
So you probably know what my next question will be then.
Well, no, where are we now? I was actually going to say, to a degree, I'm interested to know from conversations that you're having where you feel we are. But you can see from my title, perhaps where I think we are. I certainly, as I say, last time we talked, I was saying I felt we were somewhere around the capitulation stage. I think the conversations at my end, perhaps I've definitely been through despondency and depression with people over the last few months. I think it would be fair to say. I think the question is whether we're fully out of that and at the hope point, or whether that's part of what's coming down the line this year. But you know, would that seem fair to you?
I agree. Yeah, I mean, I certainly think we're out of despondency and depression. As long as we continue to see the right steps forward on inflation and interest rates coming down, then I think that will bring a lot of relief, and then the hope can definitely come back that we're on the right track for the future. So, Charlotte, look, really appreciate your time. Thank you so much for your insights today. Thanks everyone for listening, and we will obviously be here again in a month's time for our April investment update. I can't believe it. We're already in March. and we're already a quarter of the way through the year. Anyway, thanks for listening, and we'll see you again next time.